Hi guys, welcome back to the channel. My name is Dave, and today I want to introduce you to two unique offerings from Simplify ETFs, and that's going to be SBAR and XV or 15. Now, for income investors out there, these are going to distribute anywhere between 10 and 15% on an annualized basis. They're going to make that distribution once a month. And as I mentioned, these are really unique and they're brand new. What makes them unique is that they're based upon barrier options. Now, if you're familiar with barrier options, comment down below right now. I want to see how many people actually say, oh, I know what that is. I'll be surprised. So let's talk about these two and see if they're right for us. It's a first look. If that is what you're looking for, please stick around. Whoop. So let's take a look at these unique offerings from Simplify. Simplify is known for having a lot of unique products, and this is no exception. So SBAR and XV is what we're going to be talking about. But I should talk about the week in review, which is really the destruction of my childhood, which is the loss of the Prince of Darkness, no more bat eating or ant snorting. We lost Theodore Huxtable. That came out in 1984, right? I wasn't quite a teenager. I was becoming a teenager. And then we lost the Hulkster, which was like Sunday mornings after church on the couch watching the WWF. This is a tragic weekend for my childhood. So anyway, we move on and we can fix it all with finance. Okay, maybe not. But nevertheless, we're going to try. We're going to try with these two. As I mentioned, these are very unique and different. So bear with me as we talk through this and try to understand the concept and see if it's right for yourself. Now, I wonder who out there will be my guinea pig and be the first one in YouTube land to actually buy these. If you have and you do own them, let me know. They do have each around $55 million of assets under management. So they're off to a decent start for being relatively new. They're just a couple months old. So brand new. Now through this, we're going to focus on SBAR as we work through this. XV is similar, so we will talk about that one at the end. And as stated, these are new funds from Simplify, and they use what are called barrier options. And if you haven't heard of barrier options, don't worry. This was new to me as well, so I'm kind of learning. We can learn it together and fill in the gaps as we go along. Now, the expense ratio for both of these is 0.75%, and they pay a monthly distribution as shown here on Seeking Alpha from the premiums they collect from selling barrier options. Barrier options are similar in some ways to standard options. So if you understand basic puts and calls, that will help you understand these. If you don't, you can think like Gandalf. You shall not pass. You shall not pass! And then afterwards, you can go watch this video all about the basics of trading options. I have a whole playlist out there, so check that out if you're interested in finding more about basic options and how they work. But in this case, they're selling barrier options, so think of it like selling a put to collect a premium. Now with SBAR, they are selling a 1-year or 12-month structured note, okay, that has these options in the note. Now each one of these notes contains a barrier option on the S&P 500, the NASDAQ, and the Russell. So all three. So 3 options in each note. Okay, so we have 3 options working here, and they're barrier options, and we're going to pull this all together. And the barrier is set to be 30% for SBAR, below the price of the index right now. So if you look at the S&P 500, like SPY, I think it's at 637 right now. If you took 30% below that price, and we executed one of those right now, that barrier would be set 30% below that price. That's the you shall not pass limit. So think of that like the option strike price, right? Set 30% below the current market price. Now here is the bet. At expiration, 1 year later, if the price for any of the 3 indexes is below the set barrier of 30%, so the Russell, the S&P, or the NASDAQ, you lose the full value of the decline. Meaning if the barrier option was, let's say, for $1,000 and it dropped 32%, since that is past the barrier of 30%, the value of that note would be $680, or you would have a $320 loss, 32%. Now that loss would be offset by the option premium collected when the barrier option was sold in the first place, just like a standard option. However, if all three are above that 30% barrier after 1 year, you keep the full option premium and would have no loss. Now, these structured notes also have a call function for the counterparty. So once a month, the counterparty will call the notes and new notes will be issued if all three reference assets have a positive return. What does that mean? Well, if the S&P, the NASDAQ, and the Russell are all up this month, one day, they can call and bring those notes back in and reissue new ones. So when the indexes are climbing, the counterparty can reset to a 30% barrier on a set date once per month. And this call function allows us to keep the full premium, so that's good for us over a shorter period of time. That can work out to our advantage and provide a better return overall. For the counterparty, it lets them to get back to that 30% barrier. Now, this process is repeated each month so that the notes are laddered in over the course of the year, and this is the structure of SBAR. Now, I have been saying counterparty a lot. When you say counterparty, it's banks like JP Morgan, Morgan Stanley, and Bank of America. They would be using this type of insurance to protect against a crash, manage tail risk, that sort of thing. By the way, all the charts I've been showing come from Seeking Alpha, and I am a Seeking Alpha affiliate. Personally, use Seeking Alpha every day, not just for getting updates on the market, but also for research on the many alternative ETFs that I cover. So if you are looking for a stock and ETF research tool, consider Seeking Alpha and check out the links below for discount offers. It's also interesting that since introduction back here in April, we've seen it climb from $25 a share up to $26.58 while distributing income. So why is it climbing in value with a product like this? And probably the simplest explanation is if you understand selling a put. Let's say I've got stock XYZ trading at $100 a share and I sell a $95 put and I collect $100 of premium that goes on the books in my account as a liability. But if stock XYZ, like the stock market right now, is climbing and it goes up to 105, then the value of that option in my account is going to go down in value. Remember, I collected $100 in premium, and it's climbing, so the value is going down because it's less likely to be assigned to me. It's less likely to expire in the money. So now maybe it's only worth $40. And that's similar to what is happening here, right? The likelihood of this barrier being reached as the stock market is climbing is being lessened with time as it climbs. So that's the same functionality that you're seeing in SBAR and why it's been climbing since introduction, because we're in a market that's moving further away from that barrier. Now, tax on distributions from both these funds will be ordinary income, so make sure that works for you and your tax situation. These will be reported on a 1099 though, so there's no K1 to worry about. I know a lot of people don't like those K1s. If you look at the first two distributions for SBAR, we're going to see that they were 28 cents and 28 cents, so consistent so far, and based upon the current price, that would mean a 12.6% distribution yield based on the current price. I think it's probably going to be in that 9 to 13% range for this fund, so we'll see where it settles in at as time goes by. And that's really a good segue into the other fund, which is XV, which maybe you buy just because it's a much cooler name. It targets 15%. It's got a super cool name. It's like the love child of, 11 from Stranger Things and 7 Costanza, which equals 18. It doesn't make any sense, but still like the name. Anyway, so XV, it's just like SBAR, but instead of setting a barrier 30% below the current price, it's going to target a distribution rate of 15% and then adjust the barrier option strikes to reach that goal of 15%. So overall, that should create a higher risk reward for XV, but I could see a scenario where a spiking VIX could change that a bit. Now, in my opinion, Simplify does one of the best jobs of producing content internally that explain their products. So if you're interested in this idea, be sure to check out the Simplify website and the videos they have produced on SBAR and XV. I'm sure they can fill in some of the gaps that I've left talking through this. So go check those out. I'll make it simple for you too. I'll link it down below so you can click right there and head on over. But one good question that I'm sure many people will be asking is, how often does a 30% decline occur? Well, according to TradeThatSwing.com, it has happened 6 times since 1950 for the S&P 500. And I would think that the more volatile NASDAQ and Russell would typically be the trigger. So that would certainly be worth looking at a little deeper. But just for a as a point of reference, during the crash in 2020, the S&P 500 dropped around 34% in total, but it was back within 30% after just a few days. So in that particular case, the bad expiration days would have only been from 319 to 324. Another example of a V-shaped recovery. And I had to look that up myself because I was surprised. That's not how I recall it. But yeah, it was really brief when it was below 30%. And remember, that expiration date for that note has to be on that date when it's below 30%. So just because it falls below there for a little bit, if it recovers and then the expiration date occurs, you still keep the full premium and you get your money back. So there's no loss in that case, just the gain from the option premium. And I think it's important to understand that with a fund like this, your upside is somewhat limited, right? You're going to be collecting that option premium once a month and distributing that. You might see a little bit of a price appreciation with the shares depending on when you purchase those shares. But it's not like you're buying NVIDIA. You're not buying it at 120 and a month later it's at 180. You're not going to see anything like that. There is that call function where if they call because all three indexes are up and they reissue new notes, that your distribution rate might go up a little bit, but you're a little bit capped on the upside, and I think that's important to just to understand. So who might consider one of these two ETFs? Well, I guess the first person is the average everyday income investor that wants to shift out of some stocks and into something like this. But there certainly is risk should something terrible happen, but that would be systemic risk, right? The whole market. So all your stock exposure would be down in that case as well. So shifting some of that stock exposure to this might make sense, right? I mean, a portfolio of stock that is down 20% all of a sudden, this still has a 10% barrier compared to that as far as SBAR goes. For a recent retiree that is concerned about a sequence of withdrawal risk, well, this might not be the best option, right? Because something catastrophic happens and suddenly those first 2 years of retirement make everything look different. So it just depends. But, if you're not into fixed income, you want income, this might be an option. I think you could also get really creative and explore these two funds. So maybe pair this up with some put options, for example. Say you decided on a $100,000 investment, just to use round numbers, and that produced 10% or $10,000 in distributions. What if you committed $2,000 of that to buying deep out of the money puts, each one costing maybe $1,000, right? I bet you that would be about 20 to 25% out of the money, just thinking out loud. So if you had two of those, that could probably shield you from when it occurs, when it drops below 30%, you have that big loss. This could probably offset with those two put options. It definitely would be something worth exploring and tinkering with numbers if you're into that, which I do. So I probably will be doing that. But yeah, let me know what you think. How would you use something like XV or SBAR? So there you have it, two new unique funds from Simplify. Now, if you have questions on these unique funds, please ask down below. Anything about these funds or about barrier options, I'll do my best to get you an answer. But you can also check out those videos from Simplify. Again, they're excellent. They should fill in some of the gaps that I left for you. Now, like and subscribe if you like this type of content, and we'll continue to search for unique offerings that are out there for everybody, growth investors, income investors alike. See you next time. Have a great night. Take care.